Welcome back. You now have a basic understanding of the psychology of trading. We know that the market moves in waves and not in a straight line. When prices have gone up and the traders who are participating consider that it has gone too far and it is now ready to correct, it is said that the market is overbought. The term overbought refers to a situation where the price of a commodity is becoming overvalued and is prompt to experience a pullback. When this happens, the price goes so high that an oscillator reaches its upper limit. I know we have not spoken about oscillators just yet. I'll tell you about it in a second. But before we get into that, let me clarify that oversold is the exact opposite of an overbought. Obviously, if the price is becoming undervalued, it typically represents a great opportunity to buy. Now, here is a question. How do we know when a market is overbought or oversold? If periods of oversold are such great buying opportunities and periods of overbought are such great selling opportunities, wouldn't it be great to have a system that could tell us exactly when the market is overbought or oversold? Indeed it would. But does such a thing exist? Fortunately, the answer is indeed it does, and that is what we called earlier an oscillator. Remember? An oscillator is a technical tool that indicates when a market is overbought or oversold. There are many oscillators available to a trader. However, in the Meditative Trader program, we're going to work with the most common ones, stochastic and the RSI or Relative Strength Index. In this lesson, we're going to talk about stochastics. Let's see how we can bring it up in our chart. Basically, we right-click on our chart, anywhere there, and we go to Indicators. There we have a list of indicators. Then we scroll down to look for the S, and here we find Stochastics. We double-click there and click OK. And there we have the stochastics. Now, I make small changes in the stochastics, so I want to tell you what changes those are so you can do the same with me. So again, we can go to right click, go to the indicators, and there is the stochastics. So what we're going to do is that in period D we're going to change that for a 3. Okay? And the other change we're going to do is that we're going to change this. It's just a matter of taste. We're going to change this for, let's change that color to maybe a blue. And let's make it a little bigger here with the width. Let's make it at a 2. And where it says K, let's try to double click in that plus sign so we can get the colors there and change that color maybe to a red. Crimson would do. And let's change this to a 2 as well. Okay, and now the stochastic, we click OK, and it will appear a little bit different. It is more manageable for us. So now we have the stochastics on our chart, and well, let's take a look at it. Notice that it is formed by 2 lines. Those 2 lines are called percentage D, which is the blue one, and percentage K, the red one. Both these lines oscillate from one extreme to the other. That's why it's called an oscillator. It goes up and then it goes down, and it goes back up and down and up and down. So that tells us the periods of overbought and oversold. The concept behind the stochastic is rather simple. Suppose that we're talking about an uptrend. If we're in an uptrend, the prices will be moving higher, and the closes, remember that those little dash on the right side of the bar? Let's make it here. Remember these ones? The right dash, right on the right side of the bar? Well, those closes have the tendency to close near their high on the bar. For instance, this one is going in an uptrend, right? So we see the close here at the high of the bar. This one closed here, this one closed here, this one closed here, etc. So they have that tendency. And that is pretty much the concept behind the stochastics. You probably remember that in the previous lesson we spoke about how the closing was more important than the high or low of the bar. Now, if we are talking about a downtrend, then prices will be lower and have the tendency to close near the low of the bar. Just the opposite. That is the theory behind the indicator. Now, let's see how we can use it in our trading. In the meditative trading program, you will learn the most common and effective ways to use the stochastic. In this lesson, we're going to learn the first way, which is by identifying what is known as bearish and bullish divergence. What is divergence? When the price goes in a particular direction and an indicator that is based on that price, in this particular case the stochastic, does not confirm the same direction, we have divergence. In other words, or said in a simpler way, price and indicator are moving in opposite directions. So let's take a look at some examples. I prepared for you another another chart, exactly the same one, but already with the divergences marked to save time and make it easier. You can see here the price is coming down, but the indicator is going up, and so we call that positive divergence. Here we have another one where the price came down, but the indicator went up, and we have another positive divergence. Let's look for another one. In this case we have a negative divergence. In this case the price went up and the indicator actually went down. So that is a negative divergence and signals a selling situation. Here we have the price coming down and the indicator going up for a positive divergence or a buying signal. Here we have another negative divergence where the price is going up and the indicator is coming down, and another positive divergence where the price is coming down but the indicator is going up. We have another negative divergence here. The price is going up, the indicator is coming down. You can see how they move in opposite directions. And this one where the price is coming down and the indicator is going up. So a positive divergence or a buying signal. Here we have another buying signal with a positive divergence, price coming down and indicator going up. Here was a big one with the price coming down and the indicator coming up big time. So we have another buying signal. What some traders call bullish divergence, other traders call positive divergence. In other words, positive divergence and bullish divergence are exactly the same, so don't get confused with those terms. Positive divergence occurs when the price makes a new low while the stochastics start to move up, and that gives us a buying signal. Bearish or negative divergence occurs when the price makes a new high and the stochastic does not. In fact, it starts to move lower, and that gives us a selling signal. Now, from all these examples, you can see how these signals show beautifully the changes in direction of the market, and they can be used nicely as a good setup. So notice here how this signal made a big change in the market. This one made another big change in the market. This one made another big change in the market, and this one made even a bigger change. So now again you have homework. This time you're going to have a little bit more homework than before. First, you are to identify all positive and negative divergence that you can find in your charts. Remember, we're using 4 or 5 markets. You can stick to those markets. But you can use different time frames. So you can use, in this case, I use a 120-minute chart. You can use a 60 minutes, you can use a 5 minutes, or 15 minutes, it does not matter. Second homework is to identify trade setups with divergence and actually take those trades in your sim account. And third, send all your trades to us for review. Now in the next lesson, we will work on the second way to use stochastic as a good trading setup. See you in the next lesson.